Hi students, today we are going to discuss again another paper. This time is October-November 2021. So let's go ahead, let's start. Why does a trader calculate the profit of his business? To calculate the profit, the interest payable on loan? No, that's not the answer. To calculate the provision for doubtful debts? No, that's not true. To calculate the total expenses of the business? No. To know whether the drawings are at reasonable level. Yes. Why? Because the reason why you prepare actually your profit is to be able to compare your profit with your drawings. And that means the drawings should not be more than the profit. Yes? Because you should not take more than drawings than the profit you have made. Right, let's go to question number 2. Hassan is a trader. During the financial year, he took goods from the business for his own use. How should he record this? So if you are taking goods for own use, obviously you are going to debit drawings account and credit purchases. This is the transaction where we are actually taking goods for personal use. Because purchases will reduce, that's why we credit them. The goods that were meant for resale are reducing, and you're taking money from the business for personal use, which goes with the drawings account. Right, question number 3. Where are the accounts of credit suppliers found? We know very well that accounts of suppliers are found in the purchases ledger, not journal. Journal, there is no account in the journal. A journal is a book of original entry. So obviously A and C are out, and we are talking about suppliers. We are not talking about sales. So the answer is B. Question number 4. Which document does a trader issue to remind credit customer that the payment is due? Right. When you are reminding the customer for the payment due, don't send a credit. Credit note is when you have actually reducing the amount that the customer owes you on the invoice previously issued for overpayment or for returns or damaged goods. Debit note, that means the customer will send a debit note and the supplier will send a credit note. Receipts went for cash payment or bank payment. And statement of accounts is the reminder of the customer on the payment due. Right, what is a check counterfoil used for? Right, a check counterfoil is not to pay a check into the bank account. No, not to pay for good purchased by check. No, to record the check payment in the cash book. Yes, all right, because you are, after you have paid, you have to remain with a receipt of whatever you have paid. So that's what the check counterfoil does. Right, move on to question number 6. Farouk sells goods on credit. A check from Khalid, a credit customer, was dishonored by the bank. How should Farouk record this? So remember, when a check bounces, actually you are going to reverse the transaction. When Farouk was selling goods, he had debited bank and credited Khalid. But now when the check bounces, he does the opposite. He actually cancelled the transaction by debiting Khalid and crediting bank. Right, let's go to question number 7. Question number 7 says, Tumelo sells on credit. The term of trade are listed. List price 200 units. Credit period 60 days. Trade discount 15% if 10 units or more are purchased, and there's cash discount 3% if the date is paid within 1 month. Credit customer purchased 20 units, which means automatically you can see that is entitled to a trade discount, and paid the debt within 15 days. What was the total on the invoice? Remember, on the invoice we don't deduct the cash discount because the payment has not yet been made, and immediately we deduct from the cash. We take we take the amount minus the cash the trade discount. Remember, a trade discount is the one which is deducted on the invoice because it's given to a customer who purchased in large quantity. So we'll take 200, which was the list price, and we minus the trade discount of 15%, right? So now calculator, if we take 200 times 15 over 100, I'm getting 30. So the trade discount is 30, which means the amount which should appear on the income statement. Sorry, the 200, before we take out the 15%, we have to take the number of units and the times the number of units which were purchased, right? So list price is 200 and he purchased 20 units. So 200 times 20, which is 4,000. 4,000 times 15%, right? So 4,000 times 15 over 100, which is 600, and we take away from 4,000, which obviously is going to give us 3,400. Excuse me. All right, so let's move on to question number 8. Jane purchased goods and paid by credit transfer. How should this be recorded in Jane accounting record? So you're recording as a Jane, and you're the one who purchased. So if you have purchased goods, obviously you're going to debit purchases and you credit bank because it was paid by bank transfer. Right. Number 9, what is shown in the trial balance? Remember the trial balance, capital and the profit on a particular date? No, this is not the answer. Financial transaction for a particular period? No, but it's a ledger balances on a particular date. Remember, the trial balance is a list of balance of ledger accounts on a particular date. Now, question number 10. At the end of each year, PT Limited transferred 20% of the profit for the year to the general reserve. Draft financial statements were prepared for the year ended 30th September 2021, and it was then discovered that an inventory at the 30th September 2021 had been overstated by 1,500, which effected the correction of this error have on retained earnings and general reserve. So what you have to understand is that the amount which was overstated is 1,500, and when you're recording in a statement of change of equity, the 1,000, the retained earnings and the general reserve will both carry the total amount of 1,500. So if 20% of the profit was transferred to the general reserve, that means 20% of 1,500. So 1,500 times 20 over 100, it's 300. So 300 was transferred to the, what is supposed to be decreased from general reserve because it was overstated. So here we are, it's between A and B. And the rest of the money, that means the difference of 1,500 should actually remain in the return earnings, which means 1,200 plus 300 is making 1,500. So the answer is B. Right. So number 11, the bank column in a trader's cash book and the bank statement or both showed a positive balance. A comparison revealed the following differences. The question now, what was the difference between the balance shown in the bank column of the cash book and that shown on the bank statement? Right. So if there was uncredited checks, which means the cash book had a surplus of 200 because the checks were received, but they have not yet been processed by the bank. Now, there is a bank charges which the bank has reduced, but the cash book is still maintaining the 10, right? So which means in the cash book there is still 210 more than the bank statement. So The cash book balances, no, obviously A and B are wrong, right? And the cash book balance was 210 higher, yes, than the bank statement. Right, let's look at the question number 12. What is a reason for preparing a sales ledger control account? Remember, when I talk about sales ledger control account, please think about the customer's account in the sales ledger. What you do to the customer's account: when the customer receives, you debit. When the customer gives, you credit. Right? So you debit when a customer receives, and you credit him when a customer gives. Right. So calculation of the total revenue, no. To ensure the trade receivable pay on time, no. To help prepare the income statement, no. But to summarize the account of the trade receivable. Remember, the sales ledger control account is a summary of all the customers under one account called sales ledger control account. Meaning, whatever is happening in the sales ledger, what you do to the customer's account is what you do exactly to that one summarized account called sales ledger control account. Right. Number 13. Two companies each purchased the motor vehicle for 10,000 at the beginning of year 1. Company G used the straight line method of depreciation rate of 15% per annum, while company H used the reducing balance method of a rate of 20% per annum. What was the difference in the depreciation charges between the two companies? So let's start to look at company A, which has used 10,000, and this is the straight line method times 15%. Right? So 10,000 times 15 over 100 is 1,500. Now, because it's a straight line method, 2 years, it's 3,000. Well, company B is 10,000 times 20 over 100, which is 2,000. And the second year, that is year 1. For year 2, remember, if you're using a reducing balance method, we have to calculate the depreciation on the net book value. So 10,000 minus 2,000 the depreciation times 20 over 100, which is 1,600. Right? Now, if using reducing balance method is 1,600. If you use straight line method is 1,500. Actually, you don't need to multiply by 2 because the question says, what are the difference in the depreciation charge between the two companies in year 2? Right? So in year 2, $1,000 greater for G. No, actually, remember G is the one which has used the company G uses straight line method, and the one which has got 1,500. So it's not the one which is greater, but the one which is greater is 100 greater for H, because H is the one which is used reducing balance method at the depreciation of 1,600, which is 100 more than actually G. Right. Question number 14. Amir financial year ends on 30th December. The following account appeared in his sales ledger. What does the entry on 20th November represent? Right. So we are asked, what does the entry on 30th December represent? Okay, this account, as you can see, we have sold goods to Deepak. Sold goods for 3,200. He paid 1,700, and then he paid 230, and there was a balance of 1,270, and we are not shown that there is a balance carried down and balance brought down, which means what we did is definitely we have written him off and we have transferred this balance in a recoverable debt. So we are going to debit recoverable debts, okay, with the 1,270, all right, and that's the pack, and at the end of the year we're going to transfer this 200,270 in the income statement as an expense. Right, so the answer is A. We have actually written him off because it doesn't show any balance carried down or balance brought down. Number 15. Sally wishes to increase the balance on the provision for doubtful debts account at the end of the financial year. Right? So how should this increase be recorded? Okay. If you're increasing the provision for doubtful debts, it means you are debiting the income statement. Remember, to debit income statement is to add to expenses, to increase expenses. Right? So the provision for doubtful debts has already a balance brought down on the credit side. Right? So if I'm increasing, let's say it was 100, and now increasing by 20, so 20 will come here to make it 120, and the difference is one way to go to the income statement, meaning we are going to debit income statement and you credit provision for provision for doubtful debts. Okay, 16. The following errors were found after a statement of financial position had been prepared. Okay, there is a loan payment in 2 years' time which had been included as a current liability. All right, and the provision for doubtful debt which should have been created. All right, so what is the effect of correcting this error? So there is a loan repayable in 2 years' time. Well, that means this is a long-term liability and it has been treated as a current liability. All right, so and the provision for doubtful debt should have been created, meaning we should have actually considered that the trade receivable was supposed to be less, because remember, provision for doubtful debts amount is deducted from the trade receivable, and remember, trade receivable is actually current asset, so we have to decrease the current asset definitely. So I'm looking at 1 and B. All right, and the current liabilities have also to be decreased, because a loan is a long-term liability and we have overstated the current liability. So I'm here. All right, non-current asset, non-current liability have to be increased because loan is a non-current liability, and owner's capital will have to be increased as well. So the answer is A. John maintains a full set of accounting records. Why does he also prepare a statement of financial position? To carry the profit for the year? No. To check if assets equal to capital plus liabilities? No. To show the transaction which took place during the year? No. But to summarize what the business owns and what the business owes. This is correct. So 17 is D. Right. Number 18. What are the advantages of operating as a sole trader? Right. So the owner can keep profit of his own. That's very correct. The owner can raise finance by issuing debentures. Remember, debentures has nothing to do with the sole trader. So this is wrong. The owner can make decision independently. Yes, doesn't have to ask anybody. The owner is protected by limited liability. No, remember, a sole trader does not have limited liability, meaning he can be pursued for his personal assets, actually to pay the debts up to his personal assets. That's what it means, limited liability. So he has unlimited liability, meaning if he cannot pay the debts, it can even be his personal asset can be sold to pay the debt. So the answer we are getting here is A. Right. Anwar is a sole trader making annual profit of 24,000. Decided to admit Dilip as a partner. They agreed that Anwar would receive a salary and the profit and loss would be shared equally. The forecast appropriation account for the partnership for the year, for the first year trading is, right, so we have profit for the year 50,000, salary annual 10,000, profit available for distribution is 40. So how much will annual total income increase? We are looking at the increase, right? So from 24 to how much now, right? So already there is a 10,000, yes, as a salary, and the profit here is shared equally. So which means he's entitled to another 20,000, making 30,000. So there is an increase from 24,000 to 30,000 of 60,000. Right? Let's move on to question number 20. Cassie and Ravi are partnership. The financial statement for the year ended 30th August 2021 show that Ravi was entitled to an interest on capital and interest on loan and was charged interest on drawings, which entry would be made in Ravi's current account. Okay, so the current account, it shows how much money the partner has in the partnership. Remember, please, the current account, okay, increases on the credit side and decreases on the debit side. So what you have to remember there is that the actually interest on capital, it is increasing the partner's money. Interest on loan is not appearing in the appropriation account, but it comes in the current account. Interest on loan, of course, is the money the partner has loaned, has given actually the partnership as in form of a loan. So he's also increasing his money in the partnership. Interest on drawings obviously is going to decrease the partner's current account because he's charged interest on the money that he has taken for the partnership. So if you look at A, interest, if you cannot, interest on drawing cannot debit. So already this is out. So for B, again, as an interest on capital, again, there is no you can debit it in the current account. So without even going far, B is wrong. But it will be credited, which is fine. Interest on loan also it will be debited. Interest on drawings will be debited. So the answer is C. Okay. BCD Limited provide the following information. We have ordinary share, return earnings, and debentures. Then I asked how much the equity and the capital. Right. Let's remember that the capital employed is actually the capital of the business plus long-term liability. This is the total amount which is invested in the business, all right, in the company. So, but when we're talking about the equity, equity is made of ordinary share capital, return earnings, and general reserve, right? So, in this case, we have ordinary share of 300 and return earnings of 200, which makes it the equity. If we add the debenture which is long-term loan, then it will give us the capital employed. So the answer is D. All right? Good. Now, 22. Question number 22. The issued share capital of CD Limited consists of ordinary share, return earnings 86 on 1st September 2020, and 88,500 on 30th August. So this is the return earnings at the end. This one is at the beginning. The company made a profit during the year of 26,000 and made a transfer general reserve of 5,000. What is the total ordinary share dividend paid during the year? Okay, so in this case, if we can try to remember how, let me use this space here, how the statement of equity is actually made, and I'm looking at the side of return earnings. So return earnings column, we had the balance at the beginning, which was 86,000. and we add the profit. So the profit is 26,000. All right. So, and we minus the drawings. When I transfer the general reserve of 5,000. Remember the statement of equity. All right. And of course, you are asked, you minus also dividends, which we don't know. And the last amount is 88,500. So if we take this plus this minus this, then minus this, we'll get that. All right. So if we take 86,000 plus 26,000 minus 5,000 minus 8,500, I'm getting 18,500. Okay, that's the answer. Now 23. A sports club was formed on 1st August. During the year ended 30th August, the club purchased equipment costing 5,000 paying by check. In which of the club financial statement do these appear? So we are purchasing equipment, which is a non-current asset. So if you are purchasing equipment as a non-current asset, this equipment will not come to the income statement. No, it is actually a non-current asset which comes in the statement of financial position. So you have to forget about A and about C, right? But since there was a movement of money, was paid by check, which means receipt and payment is included. So the answer is A. All right. Wait, no, sorry. The income statement is not included. The answer is B. The receipt and payment, and there's no income statement, and the statement of financial position. All right. So question number 24. What is not part of the prime cost of a manufacturing business? Right? So remember, manufacturing business has it's actually showing how much money is being used to manufacture the goods, right? So now the question, what is not part of the prime cost? And prime cost are costs which are connected and related to the manufacturing of the product. So they are made of direct material plus direct labor plus direct expenses. So whatever is not direct, it means not going supposed to appear in the prime cost. So raw material, yes. Loyalty, yes. Factory supervisor, no. Production workers, yes. So wage for factory will not be appearing in the prime cost. Question number 25. The value of Tato's work in progress increased during the year. This was recorded in his financial year. How did this affect the cost of production in the cost of sales? Right. So if we're talking about how this affected the cost of production and the cost of sales, so obviously the cost of production, if they say it has increased, it means the cost, you remember the work in progress, sorry, work in progress at the beginning, we add the one at the beginning, and at the end we minus. So, which means the work in progress at the beginning was more than the work in progress at the end, which definitely decreased the cost of production, right? And if the cost of production reduces, obviously the cost of sale also decreases. So the answer is A. What are the advantages of keeping a full set of accounting records? Right. Financial statement will be free from error. We cannot make that sweeping statement to say that the financial will completely be free from error. Errors can be there, but it could be reduced. Right? So number 1 is not correct. Right. Now, number 2, it says it is impossible to make fraudulent entries. No. That is also another sweeping statement, because you can't say it's impossible. It's possible, but can be reduced, right? More informed decision making is possible. That's correct. And the calculation of profit is more accurate. That's very correct. So the answer is D. All right. Both provide the following information. Here, there are net assets at the beginning and at the end, and the drawings for the year was 3,000. What was the profit? Remember, to calculate the profit, we take capital at the end. Actually, the profit, we take capital at the end minus capital at the beginning plus drawings. Why do you add drawings? Because you're taking drawings from your profit, then minus capital introduced. Then you fund the profit. All right? So here, the capital at the end is 24,000. Capital at the beginning is 28,000. There is already a minus 4,000. And we have drawings of 3,000. So we are getting 1,000 loss, 1,000 negative, which is a loss. So the answer is A. Right, question number 28. Roshan sales for his first year trading was 55,000. Gross profit was 20,000. Okay, so we have sales and we have gross profit margin, which means you can easily fund the gross profit. Yes. And the closing inventory was 3,200. What was the purchase for the year? So if we're given margin and sales, we can easily fund the gross profit. So to fund the gross profit is 55,000. Yes. Times 54,000 times 20 over 100. It's giving me 11,000. Yes. 54,000 times 20 over 100 is giving me 11,000. So 11,000 is, 11,000 is actually the gross profit. So now, after funding the gross profit, I can easily know the cost of sales by taking 55,000. So 55,000 minus 11,000 is going to give me the cost of sales. So cost of sales is 44,000. This is cost of sales. Now, I have the cost of sales. Don't have opening inventory because it's the first year of trading. Now I'm going to apply the formula opening inventory, which I don't have, plus purchases, which I'm being asked, minus closing inventory. The closing inventory is 3,200 is equal to cost of sales. And the cost of sales is 44,000. So which means the purchases will be now 44,000 plus 3,200, which will give me 47,200. So the answer is D. 29. Which information is required to calculate the return on capital employed? So remember, return on capital employed is actually the percentage of the profit over the capital employed. So it's profit over capital employed. Remember, the capital employed is actually capital plus long-term liability. I think we had another question like this before, right? So we're not talking about, if you're looking at the return on capital employed, we don't use the gross profit. No, we're talking about the profit for the year. So it's operating profit, non-current liability, and owner's capital. So the answer is C. All right? Not working capital, but owner's capital. Right. Number 30. Number 30, what is the best indicator of the liquidity of the business? Remember, when you're talking about the liquidity of the business, you're looking at how the business is able to quickly pay for its short-term liability. And the ratio which shows this is actually asset test ratio or liquidity ratio, where we have current asset minus inventory over current liability. We minus inventory because inventory are not easy to convert into cash. Therefore, it's a liquidity ratio. 31. A trader provides the following information for the year ended. What is the trade receivable turnover days for the year ended 31st May 2021? Okay, so we remember to calculate the trade payable turnover. We take actually trade payable over credit purchases times 365 in terms of days. So the trade payable we are going to use is not the opening, is of course the closing. So I take 42,000 over credit purchases, which is 319,375 times 365, and we get the number of days. So in a calculator, if we take this 1,000, 42,000 times 365 divided by 319,375. Yes, the answer I'm getting is 47.99, so which is actually 48 days. Right. Number 32. A business provides the following information about the gross profit. What could explain the changes in the gross profit? Right. Cost of sales is decreasing. No. Because if the cost of sales is decreasing, actually we could have a profit increasing. So cost of sales is not decreasing. Expenses are not decreasing. No, that also doesn't make sense. Quality of goods sold is decreasing. No, but selling price is decreasing. If the selling price is decreasing, which means our sales are actually going lower, and the gross profit margin will also be decreasing. Right. So 33. What is not a limitation of interfirm comparison? Accounting records do not include the skill of the workforce. Not a limitation. Business may have different accounting policies. Now, it's not a limitation. Business may have different sales. This is a limitation actually. Accounting records not include the skill of the workforce, and business may have different accounting policy. Yes, it's a limitation. Why? Because when you are actually you remember the accounting different accounting policy would actually be not to be able to compare business A and business B, because for example business A is using different for example accounting of the year, or the way they are depreciating the asset is different, or you know, all these accounting policy some may not be relevant, the other one is relevant, so this would actually be a limitation. But when business have different selling price, this is not a limitation, because we don't know the cost. So that's why we cannot say that business may have different selling price, so this is a limitation. Right. So question number 34. What would a supplier be interested in the final statement of the credit customer? So a supplier is actually interested to know if the customer can pay what he owes. I think this is straight away the answer without going any further. Monthly owe, no, okay, fine. Right. Now, question number 35. What does the objective of understandability assume users of financial statement will possess a reasonable knowledge of accounting, of course, so that they can be able to understand easily the records, isn't it? Right. So we have gone through the whole paper. I hope you have actually enjoyed it. You can actually contact me on an email address. My email address is IGCSE fastcourse@gmail.com for personal assistance. Right. Thank you very much. All the best. See you next time.